All right, guys, Stockaholics, thank you guys for being here today. It is May of 2021. I'm going to be talking about tankers again today. I'll be talking about my thoughts around the oil tanker industry. That includes some ideas from both the crude and the product side of the industry. I'll be talking about rates. I'll be talking about scrapping. I'll be talking about new building. I'll be talking about sentiment. I'll be talking about oil demand. And I'll be talking about some other various topics from some oil tanker companies that have reported recently and some of the ideas that they are bringing to the fold. All right, so not a lot has changed on the rate front since our last update. The rates for oil tankers are still quite poor, and to be expected, we are in the seasonal down period for oil tankers, and we will probably continue to be for several months unless some extraneous kind of event happens to take place. But that's all there is to see here. All right, guys, so these are our new orders of tankers by deadweight tonnage. And in the beginning of this year, we saw a significant amount of ordering taking place, like we mentioned before, because, you know, what do tanker owners tend to do when they have a lot of money? Regardless of the rate environments, they are optimistic. They are more, they're less risk adverse. What do? They buy ships, right? However, it is good to see that in April, we have seen less deadweight tonnage orders. We have seen less new build ordering. And let's hope that this trend continues, right? It is, like we mentioned in the last slide, those rates have been low and they've remained low for a while. So the equity and the debt in these companies, they're kind of coming to a head. They're getting closer. So let's hope that becomes alarming to a lot of ship owners and these tanker companies and restricts these kinds of new building orders, right? All right, so this is an update on the tankers that have been sold for recycling. We have seen an uptick again in March and April, and it looks like at the beginning of this month of May, we've seen a tiny bit of scrapping. Some people, like I'm about to mention, are pretty optimistic about this. I guess if these rates of scrapping continue, that is something to be excited about. But these are okay, but what I'm really looking for are kind of like 2018 levels of scrapping. I really want I want these tanker owners to be depressed and really get out there and take advantage of these very, very high steel rates that we are seeing and sell the excess capacity of ships on the market. All right, so although there has been kind of muted scrapping taking place overall, in my opinion, according to the Maritime Executive, there is some interesting things taking place in certain segments of the oil tanker market. So this is the demolition of product tankers on pace to break 11-year record article. Unfavorable freight rates in the oil product market, coupled with an uncertain outlook and strong demand for steel, are driving the demolition rate for product tankers toward record levels, according to a new analysis from BIMCO. The Shipping Industry Trade Association forecasts that demolitions of product tankers could reach levels not seen since 2010, and if the oil spot market continues to be depressed, the trend could spread to crude oil tankers. Let's hope so. Come on, guys, scrap your ships. These steel rates aren't going to be here forever. BIMCO's analysis shows that in the first 4 months of 2021, the amount of oil product tanker capacity sold for demolition has already reached the total capacity scrapped in both 2019 and 2020. What they don't mention is that rates in 2019 and 2020 were quite exceptional, which disincentivized scrapping, and that was kind of like what you saw in the chart. We have very low rates now, so let's hope that they begin to continue scrapping, right? They believe that unfavorable freight rates are the key contributor, noting that if the current pace continues, 2021 could break records for the total capacity removed from the market. Let's go, boys! Demolition of oil product tankers is heading for an 11-year high if the current pace continues for the rest of the year, says Peter Sayant, BIMCO's chief shipping analyst. The rise in demolition sales of oil product tankers in 2021 Sands says, is noteworthy, although it comes from a very low base. See, that's what I'm saying. Whereas the amount of demolished crude oil tanker capacity has so far failed to impress the market. After the initial 2 months of 2021 saw a total of just 11 oil tankers being sold for demolition, BIMCO highlights that March and April both had 1 million deadweight ton oil tanker capacity being retired. Year to date, 10 crude oil and 38 oil product tankers have left the active trading fleet. Now, this is pretty interesting to see. I wonder why so many product tankers are being scrapped as compared to crude. Crude oil cargo carrying capacity has been reduced by 1.45 million deadweight tons compared to 1.25 million deadweight tons of oil product tankers. By comparison, in 2019 and 2020, each year 1.2 million deadweight tons of oil product tanker capacity was demolished. All right, so this is the demolition market chart. This is how much you can get per ton for the scrap steel in your vessel. So right now we are just in absolute euphoric levels of steel prices. So when I see there's such a lack of scrapping, it's really disappointing to see. And then there's also there's new buildings taking place, which presumably these guys are paying higher than normal steel prices to develop these new ships, which is just ludicrous to me, right? When you have these kinds of steel prices, and believe me, they're not going to stay up here forever, this is when you need to be scrapping your ships, right? And for reference, right, we're above 500 per deadweight per ton, of steel. Pre-pandemic levels were down here. They were in the 350 to 400 range. So you can almost get, compared to a few years ago, you can almost get twice as much for scrapping of your vessels. So for me, what I'm looking for in a tanker company are companies that know they're not paying exorbitant amounts for their new vessels in a depressed rate environment. I'm looking for companies that are savvy enough to take advantage of these kinds of elevated scrapping prices. They are removing their vessels, and they aren't fixed on a certain amount of vessels that they must have. I know this is a pattern. Maybe I'm going on a little rant here, where a lot of tanker companies, they're like, okay, we have 45 ships. We would like to maintain our current level of ships, so we're gonna order 2 more ships and scrap 2. No, guys, get rid of your old junky ships. Don't be so concerned with how many ships are in your fleet. Take advantage of these high scrapping rates, and at the same time, if everybody were to scrap some ships, your rates as a fleet are also going to go up. All right, this is the oil market report from the IEA, May 2021. Their global oil consumption is now forecast to rise 5.4 million barrels per day in 2021. And it looks like they've had several downward revisions, 270,000 barrels per day lower than their previous report. So this comes from Europe, and OECD Americas have been revised down by 320,000 and 515,000 respectively in the first quarter of 21. India's COVID crisis also led them to downgrade its demand in the second quarter of 21 by 630,000 barrels per day. But the forecast for second half 21 is left roughly unchanged. However, based on expectations that these vaccination campaigns continue to expand and the pandemic largely comes under control, which is my view as well. I don't see much of a reason for world trade to not be resuming 2019 levels when at least in a lot of the developed nations, the pandemic is largely under control, right? India might be a different story, but hopefully we can start, as Western nations start getting them some of those vaccines as well. Yeah, world oil supply rose 330,000 barrels per day to 93.4 million barrels per day in April, and it will increase further in May as the OPEC Plus alliance continues to ease output cuts. So we're starting to see some ramp up in supply from OPEC. Based on the current agreement, global oil production is set to grow by 3.8 million barrels per day from April to December. For 2021 as a whole, world oil production expands by 1.4 million barrels per day year on year versus a collapse of 6.6 million barrels per day in 2020. Canada leads non-OPEC Plus with growth of 340,000 barrels per day, while the U.S. is set to contract by a further 160,000 barrels per day. I wonder where that is. But I recently saw kind of this chart where they're kind of predicting, who knows, for these long-term projections, but they're predicting that we surpass 2019 levels as early as next year for world oil demand. Under the current OPEC Plus production scenario, supplies won't rise fast enough to keep pace with the expected demand recovery. As vaccination rates rise and mobility restrictions ease, global oil demand is set to soar from 93.1 million barrels per day in the first quarter of 21 to 99.6 by year end. Weaker than expected first quarter 21 oil use in the United States and Europe, and a reduced outlook for India due to the recent surge in COVID-19 led us to revise down 2021 demand growth to 5.4 million barrels per day. Now the thing is, as oil price has gone up to these, they're not at very high levels, at least compared to other commodities, but if they continue to increase, I'm going to be a little bit skeptical about this because that's going to become restrictive of demand. Now, it is good to see that OPEC is increasing supply, so hopefully that is going to be a downward pressure on these the price, as well as an upward pressure in terms of rates when you're thinking about oil tankers. There's more oil to be delivered, right? The widening supply and demand and gap paves the way for a further easing of OPEC Plus supply cuts or even sharper stock draws. The group is set to meet again on June 1st to review its policy. By that time, there might be clarity on indirect Iran-U.S. nuclear talks taking place in Vienna that could result in the return of Iranian oil. That would be big for supply side, right, to the market. But India's COVID crisis is a reminder that the outlook for oil demand is still mired in uncertainty. Until the pandemic is brought under control, market volatility is likely to persist. All right, so this is a chart from FlightAware. They are tracking the commercial airline traffic. I believe this is daily flights taking place. So in 2019, there were approximately 100,000 flights per day taking place worldwide. And in 2020, that fell off a cliff during the COVID lockdowns to a low of about 25,000. And since then, we've really remained around this 50,000 flights per day level. So ever since the summer of last year, we've been approximately around half the normal amount of flights that we've seen in 2019. And this has been a big damper in terms of oil demand. To put that in perspective, about 8% of oil demand worldwide is from aviation fuel. So that means that 4% you can account of total world oil demand, you can account for a loss in terms of aviation traffic, right? Now, there is some other points to think about here too. When we're thinking about road travel, we're thinking about gasoline demand. In most of the world, these road traffic, the gasoline demand is starting to approach, if not already, especially in some of those eastern nations, 2019 levels. So the main damper that still, the overhang that still remains in terms of oil demand is very much largely still just this commercial airline traffic. All right, so recently when I was listening to Ardmore Shipping's earnings conference call, I saw this, and I thought this was really interesting, so I wanted to share this with you guys. This is refinery dislocation across the world. So what you're starting to see, and well, we've been seeing, the trend is your friend. A lot in these Western nations that have these large decarbonization goals, what they've been doing with a lot of their refineries is they've been shutting them down. They've been closing them. Same in Australia, South Africa, Europe, and the United States. But Eastern countries, and there's one very large one in Africa, have been doing just the opposite. They've been opening their refineries. Now, there is something interesting to think about in terms of refineries. They are very unpopular for a reason. Nobody wants to have oil refinery in your backyard. it's messy, yeah. But what this means is that when in terms of product deliveries across the world, that means that we're thinking about product. That means that the products are going to be having to take likely longer and longer routes across the world to deliver a not crude but the actual refined product, right? So these are the global impacts according to Ardmore Shipping. Continued trend of refinery closures in Europe, US, and Australia, with refinery openings in Middle East and Asia. Once refineries are closed, they are converted to refined product import and storage terminals. So all of these red dots, they just kind of hold this refined product. They still kind of serve a function. They just don't really produce from crude to refined products anymore. Refineries that once imported crude are now importing finished refined products. The refined products are being sourced from new mega-scale refineries in the Middle East and Asia. They project, this is according to Ardmore, significant impact on product tanker demand. So they say each 100,000 barrels per day refinery shift equates to a demand increase of approximately 20 MRs, which equates to 1% MR demand. So they're saying if this trend continues, this is kind of like the equivalent of scrapping your MR fleet, as if these refineries were at prior levels, right? The Kwinana refinery closure in Australia in late 2020 resulted in an additional demand for approximately 20 MR. So I guess they're citing one of these closures and its actual real-world effects. So if this trend continues, this is very something interesting to me. I kind of wonder, though, when I see this, is like, how does this affect the crude market? Is the crude, which is largely comes from the Middle East, is that going to impact those routes negatively? On the flip side, does that mean that their routes their deadweight miles are going to be shorter? Now the U.S. is still a large producer too, so does that become neutral when they're no longer refining it and then they're sending their crude products somewhere else to be refined? I don't know. So if you have some insight on this, I would be very fascinated to know what your guys' thoughts around this are as well. Overall, we expect refinery dislocation along with oil demand growth to support product ton mile demand growth of 2 to 3% per year. So if you see continued scrapping and you see increased oil demand and you see this trend continuing, this is something for, at least I think, to be excited about, at least in terms of refined or product oil tanker companies. All right, so I've been chatting with this guy, Capital Markets 22, for several months, and I believe he has a pretty reasonable grasp on the oil tanker industry. So I wanted to share something that he sees and Euronav also mentioned, and that is Euronav claims illicit tanker trade is dampening scrapping. So what this guy Capital Markets says, I think Euronav nailed it on the head with the scrapping issue. There is a lot of old ships that are trading illegal oil since they can receive premiums above current tanker spots that allow them to continue to operate at profit. So there's, if you think about Iran, you think about Venezuela, these countries have been engaging in an illicit oil trade. They've been shipping oil off to different places. So if you think about the kind of dodgy characters, the dodgy shippers, the dodgy companies that might be doing these kinds of things, those ships tend to be very, very old. So these guys have been, using these countries to make a profit when they probably otherwise would have sent these ships to the scrapping yards. So those old ships will not be able to get premiums on spot anymore, and will be losing money fast since they are also non-eco. mostly, which eventually, as in sooner than later, would make more for that ship just from scrapping when you think about the high scrapping prices. So if these sanctions get lifted, you think about the political situation in the United States, when maybe there will be less of these kind of trade war situations that have taken place like under the Trump administration. The potential for that could be for these sanctions to actually remove vessels if they get removed, which is kind of interesting to think about. So once this happens, the tanker spots will rebalance, and thus increase in scrapping will then happen. So if the trade in these countries, they have other means to do it, they won't be using these dodgy oil tankers anymore. These ships won't receive any business anymore. Now, when I was kind of thinking about this a little bit, I saw that interview from what's his name, Monish Prabrai, right? He mentioned in the last super cycle for oil tankers, there was this effect when you saw there were double hull tankers that were being reintroduced into the market because of environmental regulations versus single hull in the prior generation, right? So the problem with single hull tankers is that if you smashed into something or you hit a rock or something, the chance that you were going to leak out oil into the environment was very high. So due to environmental regulations, there was a bunch of ships that were required for them to be produced where they were produced with a double hull instead. And so if they smash into something, the chance that you were going to leak oil into the sea decreased substantially, right? So Monish, what he mentioned is that there was a certain point when rates were very low in the last before the last super cycle, where these single hull tankers, they couldn't, essentially there was no incentive to use them. They were receiving almost no business because oil companies, they could hire a double hull tanker for the same rates that they could hire a single hull. And if you're thinking about your image as an oil producer who's going to ship oil somewhere else, would you hire the single hull ship who might spill oil and damage your reputation and cost you potentially millions and millions and millions of dollars in damage? Or would you hire the double hull vessel for the same price, right? So what does this do to the owners who own single hull vessels? Well, they don't get any business. And if they can't get any business, what are they going to do with those ships? And what he mentioned, a lot of Greek owners at the time, there's still a lot of Greek oil tanker owners out there, they did is they go and scrap those vessels, right? So I was kind of wondering, when we're thinking about all the ESG kind of stuff out there, when you see low rates, when you think about scrubbers, when you think about different fuel, cleaner fuel requirements, if all of these kinds of ships can receive premiums, what's going to happen to the non-ESG ships, or especially these very old vessels who could potentially tarnish your reputation? I would imagine that they'll just not get any business regardless of the rates, whereas other people will get more rates, thus incentivizing these less eco ships to head to the scrapyards, especially these very high steel rates. Now, I mentioned at the beginning of the year, I still think this is mostly true, that we should continue to see very high scrapping. I'm hoping to 2018 levels of scrapping in the future this year. All right, so this is kind of my opinion on how I see everything that's kind of going on in the oil tanker sector at present. So I still believe optimism, it still remains quite high in the tanker sector. The way you can kind of see that is that many share prices have doubled over the lows since last October. They've been in a defined uptrend despite very, very low oil tanker rates. Scrap rates in terms of steel pricings are in the stratosphere. And personally, I don't believe they're going to stay there much longer. So what I really want to see is these guys taking advantage of that while these steel prices are up there. If you're curious on why I don't think steel prices are going to stay at these levels much longer, maybe I'll put a link somewhere over here where I'm talking about why I think that commodity prices overall for many sectors are very likely to be lower than they are within a year or so. So see my commodities video on why I believe that. Now, I hope many tanker companies take advantage of these high scrap rates while they're here. The scrap rates that we've seen, like I've mentioned before, they're pretty disappointing considering these amazing steel rates. And I think that these are indicative of these tanker owners' resilient optimism. They still got some cash from 2019 and 2020, and they're like, there's a lot coming to a head. Although the rates are low, I still think that if we can hold on to these ships a little bit longer, the chance that we can make more money in the long run is high. Now, if everybody shares that opinion and nobody goes out to the scrapyard, that's not that means that a bull cycle is never going to happen, right? Now, there are lots of reasons, despite what these guys, the lack of scrapping, there is still a lot of reasons to be optimistic. So the refinery closures in Western countries are likely to increase ton miles for product tankers. Now, I kind of had a question about this, and I'm probably going to try and learn a little bit more about this. If anybody knows something about this, I would greatly appreciate a comment below. This is probably some advanced tanker stuff here. So the question remains, what does this mean for crude carriers? And this is my question. I was wondering, if there happened to be a severe dislocation from crude to product, right? Let's say that product tankers were just receiving, $50,000 per day, but crude were receiving, $6,000 a day. Would this incentivize some crude tanker owners to convert their carriers to product, right? Now, I know that I guess I need to think about if this is really economical, right? Or maybe if it's even possible. I know that the vice versa happens occasionally, where older product vessels are converted to crude, and it becomes simple because there's these kind of what do you call them, like paint coverings that protect the vessel and keep the products clean when it's in the clean vessels. But crude carriers, they don't really need that. It's just a bunch of basically just unrefined garbage, right? when in their vessels. So if you've been hauling around crude for a while, it's going to be difficult to convert it to product because you'd have to clean it out, and then you'd also have to put those layers on it to protect the product in it. So I was wondering if there was a dislocation, at what point would those people be incentivized to say, you know what, there's no hope for crude, there's too many, and we can make way more money if we convert this to product. I wonder if that's possible. So if you have knowledge on that, or if I'm just sputtering some nonsense, let me know below. Now, I've been noticing all of these things, and I've been wanting to be in them, but the sentiment has just kind of been really driving me away. It's like they just feel like there's elevated share prices compared to where there should be with rates, right? So what I've been thinking about, kind of refine my strategy a little bit. And I'd like the tanker story. So what I'm probably going to be doing is selling puts into a few of my favorite tanker names over the coming weeks. So in this way, I can receive some premium on companies that I would be happy to hold. And if the prices happen to drop, well, then I can purchase those for less than where they are now. And if it doesn't happen, and the prices keep going up from here, well, then I receive premium for basically doing nothing, right? So that's probably what I'm going to be doing in the coming weeks. Now, I really want to see high scrapping. I think I said this many times, and I want to see capitulation in these tanker owners. I just really feel just like there's a lot of optimism affecting all kinds of people with summer and pent-up demand and increased incomes, especially in the Western world. I think that this, just like it's probably affecting a lot of investors, especially retail, I think it's probably affecting these tanker owners too. Now, I think there's a lot coming ahead here. Yeah, there's the potential for ton-mile dislocations. The fleets remained very old. We have low oil demand, but that's going to be changing in the coming years. Like I've said many times, we have these insane high steel prices, which I wish these guys should be taking advantage. And there's also this massive widespread belief in this ESG mindset. When I listened to a conference call like EURN, these guys spent like 20 minutes on the call talking about ESG. I was like, yeah, okay, okay, but if this is a pervasive idea like that Monish Prabhai mentioned between single hull and double hulls, if this is a widespread belief in what do you call them, oil companies, the guys who are shipping this stuff around, not the tankers but the producers, then this could have really, really exciting effects. So I still maintain that I think that there's still going to be a bull cycle coming in the next couple of years. And let me know what you guys think. Am I becoming overly bullish again? Anyway, let me know. I hope you guys have a great weekend, and I'll see you guys soon.